Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS, an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to look at how to find your best options trading strategy using the ORATS Backtest Finder. We'll go over many of the 37 different performance metrics available in each backtest. Matt, do you want to share your screen and get us started by going over our XSP trade from last week?
Sure. And we had some other living trades too that we could go over as well. So yeah, we'll start with XSP. We had these trades last time. We sold a strangle, we bought a strangle, shorter dated, and we have a long dated strangle that we purchased as well. Unfortunately, with the rally, this finished in the money, so we lost some on that first one. So let's look at that. So here's the market, Tyler. Let me get my drawing tool going. So it just went straight up, which is not good for one directional move. Is not good for a strangle, and so we lost. We sold it for 50 cents. We bought it back in for $1.70, so $1.20 on that one. And let's see, we made money on the long strangle, not nearly as much, 13 cents. And then the other one expired worthless as well. So that the XSP, not so good. The other ones that we had on, we had some just single calls and puts in particular stocks. The ones in August are still going. The other ones expired. So we could see the August one. So that's TRP, or actually WES. So that's up pretty good. That's doubled. So we're up on that one, and the other ones are still going. SMH we had as well. We sold for $9. Is that with this one? That's Lux. The one that we did is about the same. So that's the older trades, Tyler.
Awesome.
So today, go ahead.
Well, I just wanted to remind our viewers why we placed the XSP trade. It was we were comparing XSP to SPY and comparing the risks between the two. And Matt, do you have any sort of idea on how that trade would have performed on SPY given the risks of a short strangle when the market went up that fast last week?
Yeah, it would have been very similar. Where the real problems lie is when the stock closes close to the strikes that you're short. That's called a pin risk, meaning that the stock pins at the short strike. And what happens in those cases is, since you're able to exercise or basically keep the option going in SPY past the expiration for an hour and a half, if 5:30 is the last exercise time, that those small options that you would normally not exercise could come into the money. So that's the big, and this one closed in the money enough to where it wouldn't have made a difference, Tyler. But yeah, good point.
Gotcha. Okay.
Yeah. So today, we do consulting work, and one of my consulting clients, we're talking about, what's better to do, one strategy or the other strategy. And so I'd like to talk about, the lessons that, and how to choose the strategies that you might want to think about. And so for this, we'll go to the backtester. The backtester now has 181 million backtests in it. And so you could sort through a lot of different ones and learn a lot from this. Obviously, backtesting is no golden goose, but you could learn a lot from it. So one of the things I wanted to look at was, let's compare a short put with, and then I could open in a different screen, with a short put spread. So, and then what we'll do is we'll look at, so let's kind of narrow this down a bit. So 30 days. So yeah, we'll say our short puts will want between 7 and let's say 45 days. And the delta is, I don't know, 0.1 to 0.4. That's the short put. And then we'll kind of do the same. I forgot, 7:45. And I'm just able to tab through. So we'll have some similar looking spreads here. So, and then what I want to also do is say these are in what we call the enhanced backtest. Let's just go to and see none of the triggers, select none, and none and none. So this will give us, and then we'll a higher percent of the time. So we're going to do the same here. We want none, no entry triggers, no exit triggers. Okay, so then it's more comparing apples to apples. And so what we're going to do is we're going to say, well, what is better? Like, what do we like better? Now, it's currently ranked by what, and you could rank it by many different things. So best overall performance, and you could read what that means. One of the ones I like to do, and we've made it the default, is looking at the P&L average per day and dividing that by the worst monthly return, worst annual return, and maximum drawdown. So, you know, those factor into what, how we're ranking these. So you might say, well, why does this one rank better? It's 3.42, and this one is, you know, 5.34. Why is this one above? It is because it has different worst drawdowns and all that. So the drawdown for the first one is 20%, 19%, and that was 33%. So there's there's also a Sharpe ratio slightly better on this one. So you know, again, everyone's going to have you know, kind of differing opinions on what is better between those. So one of the things that I started looking at was, well, you know, how does this do? We have this thing called, you know, bear market, that where we only test these in bear markets and only test these in bull markets. So it's really interesting to see that ratio. I don't even know that we've talked about this, Tyler, but so we break down the bull markets, and you could read this, but the bearish, this is the bearish market from November 07 to February 09, Volkswagen February 18, and then the rest, including COVID. So you could see how the particular strategy did in those times, and then you could see how it did in bullish times. So, and I think that, you know, again, that's another thing to look at. It's like looking at something on a drawdown, like looking at a worse month or a worst year, but this is like, you know, a worse time of the 2007 to 2024 timeframe that we're looking at. Does that make sense, Tyler?
It does, and I just posted in the comments, if you guys want to follow along with the definitions of these returns, so like best return on risk or definitions of any of the parameters we're showing here, you can visit that link, and it's a page on our ORATS University that sort of explains everything that Matt is talking about here, sort of in more detail. So
right, yeah. So here's
ORATS, follow along.
Yeah, ORATS University has a wealth of information. So yeah,
it's in that measuring performance section right there, Matt.
Yeah. Okay.
Yeah.
All right. Cool. So yeah, to learn more, go to the university on orats.com. So anyway, back to our discussion here, Tyler. So, you know, again, 3.42, and then maybe, you know, is it better than this 5.34? This, you know, what's the best out of these top three? Which ones would you choose, right? So
right.
You might say, well, in the bear markets, this one lost 9.5, 12.49, 20.79. And then you say, well, how much did it make in the bull markets? And that ratio, I think, could be important. So just to look at the first one and the third one, for example, 9.58 divided by 7.87. So that's like 21% worse, or worse on the during the bear market. So let's look at the next one. So it's 12.49 divided by 9.68, and that's 24% worse. Did I do that right? I hope so.
Yeah, I think you did. I think you just there was a decimal missing.
The decimal there. And then all right, and then 20.79 divided by 16.77. That's 23. So those are all higher, right, than the first one. So that's another type of reading that you could look at. So 21%, there is the ratio, basically, more of loss in the bear markets. Does that make sense?
It does. I wonder if there's a quicker way to do that calculation if you filter based on the max drawdown and then set a minimum bull market return. I wonder if that's a better way to.
Yeah, you could do that, and I've done that. It's not exact to where I'm going for, but I mean the max drawdown does show you some good information there. But also you want to it's the max. It's the max drawdown. It's kind of you want to see what your return is divided by the max drawdown. So it's a ratio that we don't really have in here yet. We have the Sharpe ratio and Sortino ratios, which come close, but this Sharpe ratio rates the second one more, and the Sortino rates the third one more, which I don't necessarily agree with. Of course, as you know, I'm pretty risk averse on this stuff. So let's just say that, so you say, okay, so I like the 20 delta 30 day. So let's go and compare that to a put spread. So now let's look at these put spreads, Tyler. So then, again, we'll look at the top three here, and we'll look at the annual return during bear markets and the annual return during bull markets. And I know you'd like it to be more efficient than this, but let's just type these out real quick and see which. So this is 11.45 divided by 8.91. So already that's much higher, right? The 28% is higher than the 21.
We're still sorting on best return on risk here.
Yep, this is best return on risk. And so these are already my favorite of these. And so now we're just kind of going through, well, we're doing one more, 14.54 divided by the 10.74. So I think what we're going to see is, that's 30%. And then this might not be as bad, 8.51 divided by the 7.24. So that's only 17%. So that's actually, that would be a better one in my case, in my thinking. So interestingly, so this is a put spread. So now, how do we compare this put spread with the, short put? So, let's look at, so 2.86. So now we'll start to narrow this down, right? So this was my favorite short put, and this is my favorite short put spread. Now you can see that the short put spread, looks a lot. Let's just take a look at these. Looks a lot more volatile, which is kind of which is interesting to me. So let's look at some more performance metrics. So 100% of the time, that's great. And then the short put spread, 100% of the time. So they're both in the market the whole time. Win rate 88.6, win rate 90.5. No great shakes there. So what are we going to look at, Tyler? What do you think is important to you to compare these two different strategies?
Yeah, and you could look at some. I mean, there's a lot of performance metrics here. I mean, we can look at the number of drawdown days. I think the short put has far fewer than the short put spread. That's on the right side in the risk category, 127 versus the spread has almost double that, 300.
Yeah. So the drawdown is what that means is how long does it take for you to get back to your high water mark. So like we were up here at 96,000, and so then we're way out here until we get back to 96,000, right? So that's the year there, right? And in the short put, so it only took us to here, and that's about half the time.
Okay, interesting.
So that's how that looks. That's how that works. That's interesting. I wouldn't have looked at that, but that's cool that you did. What
How
else?
about profit and loss per day? Like
yeah, well, that's going to be pretty. That's going to be already pretty similar because it's in the market the whole time.
Okay.
But it's 0.0136 for the short put, and it's 0.0114 for the short put spread. And again, this has a lower annual return, and the drawdown is 17% in the short put spread. The drawdown is 19% for the short put, which is interesting because the short put has unlimited downside,
right.
But it's far enough out of the money and it's long term enough to where it gets pretty far out there. So, for example, if you look at a recent trade, I guess the most recent trade. So if you look at in February when the SPY was 508, you're selling the 493 put. So that's relatively far out of the money for a 37-day put. So what else would you look at, Tyler? What's your favorite between these two? And if you don't know it yet, what would you look at to find that out?
Well, I just like the short. I like the short put alone, just because it really doesn't have as much drawdown as you think it would, according to the back test. So the spread, you want to cap your loss, but it just looks like the short put on its own is doing fine.
Okay, so what I would say that is, again, you have to look at it relatively. Like, so I would look at it, well, I've made 286, right? 2.86. Because if it's the same, if we had the same returns and the only thing was the drawdown was greater in the short put, you'd want the short put spread, right?
Yeah, I guess that's true. Yeah.
So 2.86 is the return. Let's just say divided by the drawdown, 17.54. Maybe we'll call that like the capital that we need. So that's 16.3%. And then, so let's go over here and look at 3.42 divided by the 19.24. That's 17.7%. So that's quite a bit higher return, right?
Yeah. I mean, don't you have to consider things like, with the spread, it's a capped loss, so you don't need to have the, cash or margin requirement in your account. With the short put, you're not going to be allowed to put it on without having the money in there.
So that's what the next thing I was going to say is the annual margin return, 27% for the short put, 25.67. So that accounts for that, for how much you need to have on.
Oh, it does? Okay.
Yeah. And the reason, you would probably say, well, why is that, right? Like, well, the answer is for a very far out of the money short put in a large market ETF, the margin isn't as great as you might think.
Interesting.
So it's capped at like I think 10% or something like that.
We could look at the monthly returns and see if there's anything that's egregiously off in one of the months where it's not in another one.
Actually, that's a good point. So I like to look at these, the monthly returns. So when I look at the monthly returns, I'm always seeing 2018, everyone has problems in December and October. And of course, in 2022 and 2020, 2020 especially, that's the COVID, and then the great financial crisis is here. So this is a short put spread. So let's just remember. What should we look at? Just a month. Let's look at the year. So we're down 8.6, 3, and 2. And then for this, we're down 10, 1.3, and 3.
Yeah, I mean, the short put definitely looked like it had some worse months than the
Right.
spread.
Okay. So that's, if you just look at months, 11.75 and the 720. And then if you look at the short put spread, 7.5 and 3.78. So that's quite a bit less. So I mean, again, it has to do with your appetite for risk, but I don't know how you feel about it, Tyler, but I certainly like this short put spread a lot more. So just
Yeah.
because I
Well,
mean, why?
I'm
Why anything
starting
is,
to like it more. Just
yeah.
looking at the monthly returns, you can see there's just looking at the heat map. There's a lot less red in
Yeah.
the spread.
Yeah. So again, I think that there are many different ways to decide which type of a trade that you want to put on, or but I think that this is one of the things that I like to do. And then finally, we've talked about this, so I'm going to save this to my favorites, and then I'm going to find similar back tests. So I'm going to find so we won't have exit triggers. Okay, so when you find similar back tests, you're not going to find any because it's so constrained that you're only going to find these. So maybe what we'll do is we'll spread out the 36 to 20 to 50, and then instead of 23, we'll go from 15 to 0.40. And then leg 2, don't forget to do your leg 2. What did I say? 20 to 50. And then now the leg 1 is going to be different. So this is way out of the money. So you might go 0.02 to 0.2. So we don't have that many more, but we do have a few. So what I like to do is sort descendingly. So these are the worst ones nearby. And even in that case, there aren't too many bad ones. Do you see that, Tyler?
Yeah. Yeah, there's only one that has less than 1% notional annual return.
Yeah. So let's do the same thing with the short puts just for kicks. So 20 to 50, 0.05 to 0.4. And then, let's just sort this.
The exercise here then is looking to see if similar backtests have better or worse results, sort of looking at the surrounding area of that backtest. And if
you want to make sure that you just didn't overfit or get lucky on
right.
that one. So, so the worst one here, way out of the monies, you probably wouldn't do that. So that's not really that. I put maybe 0.15. So again, these are all pretty close. And again, this is 24 days, and this is pretty tight between these two. So you're not going to make that much, but you're not going to lose that much. So not that great of a comparison. There's that ratio between the bear markets and bull markets. Sharp ratio, much higher for the wider, if you're really tight, you're going to have small drawdowns, but you're not going to make that much. So again, I like our choice. So again, if we go to my favorites, the short, where does it go? Sometimes these are a little bit tough to find.
I think it's at the very bottom there. No, that's IWM.
IWM. So what was a short put spread? It was, of course, I have
Oh, there it is. Yeah.
this one.
Yeah. No entry triggers, no exit triggers.
Right. Yeah, there it is. So why don't we put a trade on for the strategy, and we do that by scanning for options, and then so it's finding these trades here, and it's ranking these based on a distribution. Maybe I'll add our forecast, risk rewards, all that looks good. I like to filter down the smoothing. -2 is too much for SPY. It's sometimes difficult to get. So I go a half of a vol point, both sides. And then you could do open interest or volume, but that's not that important for this one because, it's SPY. So this is basically the choice. Selling the August 16th for 230, 16 to 1 risk reward. Your reward, it's pretty wide, 40 point. So that's like 4,000 minus what you're getting for it. And that's why the margin returns are pretty similar, Tyler. It's because there is a lot of risk in this one.
That makes sense.
Yeah. All right. So let's do this one. It's only one set wide, so we'll probably just force it here. And okay, we'll send this to our paper trade. Do you want to send the short put to the paper trade, or is it?
Yeah, I mean we could just to see it.
All right. So my
They're both
favorite.
about a month long, so we'll have some time. We can look at the risk as well.
Right.
Let me send that.
All right. So yeah. So here's this risk. So selling, it's a little bit fewer days. August. So the risk there is actually a little bit less, but it's unlimited as it goes down. And yeah, again, obviously very tight. We'll force it. And so what we'll do is we'll add an alert. And
Yeah, I mean that payoff diagram looks so similar.
Yeah.
To the other one. So it's almost like the payoff diagram. It's so similar. You can just do the spread and not have to worry about
Right.
having a huge downside risk in your portfolio.
Right. All right. So those are the two trades that we'll have on that we'll watch. Is there anything else?
I think you did a good comparison, and that's really the power of the backtest finder, is that you can look at all these different types of backtests that we've ran, and not just on SPY, but on over 100 symbols. And you can look at short puts, you can look at spreads. We even have calendars in there. So you can compare all these different types of strategies for many different symbols. So it's a really powerful tool to find the right strategy for your portfolio. And just like, Matt's saying is, a short put has, a lot of downside risk. Do you really need that downside risk, or can you find a spread that accomplishes the same goal without the risk?
Yeah, it's a good point, Tyler. Another thing that you could do is, let's just say if you're selling single name, you could look at quite a few different stocks in here. So, we could look at, Apple, Adobe, similar types of stocks, and you could really expand this to see, hey, how, I like to find similar back tests to make sure we're not overfitting, but now you could do the same strategy in a lot of different underlying stocks and see how those do. So I think that's really, really neat to do.
Yeah, it's definitely a very powerful tool. And at the end of the day, if you want to run a custom backtest, you can do that as well. You can just click on one that you like, click edit, and it'll autofill all those parameters in there.
Yeah.
Yeah.
Cool.
All right. Well, if you guys have any comments, make sure to write them below, and you can also post in the community group on in the dashboard if you're a subscriber. So if you have any feedback on the video or just in the dashboard in general, you can post there, leave a comment on our YouTube, or email us at support@orats.com. Thank you, Tradier, for hosting us, and we'll see you guys again next week. Thank you, Matt.
Thanks, Tyler.
Thanks for watching. Please be sure to take some time to read the disclaimer. Thank you.